What's up, stock traders? I'm What the Duck from Pennyboy Stock Alerts, and today we'll be going over the ATR indicator. So the average true range indicator, or the ATR, is an indicator that is used to measure the volatility of a stock. It does this by taking into account the true range of a stock over a certain period of time. So what does this mean? Well, the true range is a little bit more complicated than, say, the price range. You see, the price range of a stock is the high minus its low for a trading day. So if a stock had a high of $5 and a low of $3, then the price range is $2. Because you get 5 minus 3 equals 2. So the true range of a stock takes into account the following: the current high minus the current low, the absolute value of the current high minus the previous close, and the absolute value of the current low minus the previous close. And we can go over absolute value, also known as intrinsic value, and how it differs from relative value in a later video. The ATR is shown as a moving average using 14 periods of the true range. 14 is the default setting in Webull and most other trading sites. However, you can change it, and then the ATR will be shown as a moving average using the true range of however many periods that you set it as. So if you're looking at the daily chart, you set it for 20, you'll be looking at the ATR of the past 20 days. Let's go ahead and move on to the next slide. The shorter setting will give you more signals. So the shorter that you set your settings, the more signals you will get, being buy and sell signals, or even reversal signals. Whereas the longer the settings are, so if a bigger setting, so like 20 or 30 or 40 as opposed to 2, 3, 4, or 5, the longer settings or the bigger settings will give you less buy or sell signals. Just kind of like the standard deviation indicator, which we did go over in the last video. So this is because the longer or higher you set your settings at, the more days are taken into account, or minutes, or whatever periods you're looking at, depending on what chart you're looking at. And that will make it more reliable as far as the longer term settings go, especially with longer term trading. Kind of like with the moving average, how the 10-day moving average might get broken as a resistance or a support a whole bunch of times in a trading day, while the 200-day moving average might not, because the 200-day moving average takes into account more days or more periods, and so it's a little bit more reliable as far as long-term trading goes. So remember, the ATR measures volatility. So let's just say that you want to figure out the volatility of a stock over a period of 7 trading days. Maybe news came out a week ago, or whatever, maybe there's another reason, whatever it may be, you want to narrow it down to 7 days. So you go to your daily chart, you figure out what the 7-day ATR is by going into your settings and switching from 14 to 7. And then you have the ATR of the past 7 days, or the average true range of the past 7 days. So you can kind of tell how much the stock has been moving on average. So the higher the ATR, like I said, the more volatile the stock is, and you can compare its volatility level to the stock's past patterns to see if it's experiencing high or low volatility. So what this means is to compare the current ATR to the stock's past ATR to determine if there is high or low volatility. And if the ATR is higher than it has been in the past, then that can show high volatility. If the ATR is lower than it has been in the past, then that's showing low volatility. The reason for doing this is because the actual ATR number can't determine the actual volatility of the stock. What I mean is that each stock has a different ATR based on the stock price. So for example, a penny stock might have a high ATR when the ATR is 0.13, but for a stock like Apple, a high ATR might be something around like 5.2 or 7.3. So you can't use numbers to determine high or low volatility. Like with the RSI, when it's over 70, it's considered overbought, and below 30, it's considered oversold. No matter which stock it is, that's not the case with the ATR. An ATR of 2.0 might be high for one stock, but it might be low for another. So you have to compare the current ATR to the stock's past ATR as far as the numbers go, as opposed to looking for certain numbers and saying, oh, it has 2, well, that must mean it's volatile because the other stock had 2 and it was volatile. They're not. The numbers don't matter as far as the separate stocks go. So you're looking for past trading patterns. A lot of the time, if a stock is showing signs of low volatility, then this means that there might be high volatility coming, and the other way around. So if there is high volatility, it's usually followed by a period of low volatility. This is because with stocks, whenever there is give, there is typically take, and that's how it works with a lot of the indicators, just in general, like oversold and overbought indicators. A lot of stocks go from oversold and then to overbought, and then oversold and overbought, and back and forth again. The same thing goes with resistance and supports. They go, stocks go up and down between the support and resistance. There's always give and take in the stock market. So if you look at the ATR on the charts, which we will be doing in a little bit, you will see two numbers. On mine, you're going to see a 14, and then the next number will be the ATR. So the 14 is the time setting that I'm using, which you can change, and then the next number, like I said, is the actual average true range, so the ATR. So if I'm looking at the daily chart, I'm seeing the ATR of the past 14 days, or the average true range of the past 14 days. If I'm looking at the 1 minute chart, then I'm looking at the average true range over the past 14 minutes, and so on and so forth. So if I'm looking at the ATR on the daily chart, that means I'm seeing what the stock's average price movement is over the past 14 days. So if the stock's ATR is 3.40, and the stock already has moved $5 on the day, well, one can assume that it's already moved more than average, because on average it moves $3.40 because the ATR is 3.40, and it already moved $5, which is more than average. So if there's no news out, then this might not be a good trade, or might not be a good buy, as the odds will not be in your favor, or might not be in your favor, because you never know with the stock market, anything can happen, but it most likely will not be in your favor, seeing as it already moved more than it does on average. So the stock has already moved $5, whereas it usually moves on average $3.40. So you can assume that the stock might start to fall back to where its average trading range is soon. So getting into a stock like that would be like getting into a stock that already ran 100% on the day. It's going to be much more risky. So if you're shorting a stock, you can take that into consideration, especially if mixed with a few sell signals from other indicators such as the super trend indicator, MACD, or the moving averages, all of which we already went over in past videos. But you can kind of use that if you're shorting a stock. If you see some sell signals going on, you see that the stock has already moved more than its average true range, you might assume that there might be some pullback. You might start trading back, back towards where that average true range is. You might want to start a short position. That, of course, is very risky, because shorting stocks is a really risky strategy to use. So I definitely do not suggest it unless you know how to do it or practice with paper trading. So on the opposite end, if this price of a stock has fallen without bad news, let's say the stock went down $5 and the average true range is 2.50, this means that the price has moved way more than it typically has in the past. So one can assume that the price drop is an overreaction, and the stock might start to recover. You can use the signals we went over in the last video using the standard deviation indicator to see if there is panic selling going on or if the price drop is warranted. You can also use the ATR to determine how much money to put into a stock based off of your risk tolerance. If the stock is experiencing high volatility, you might decide to put less money in, as the stock might be more risky, or the other way around. Or if you are into the high risk, high reward kind of plays, then maybe you'll just do the opposite and get into the play because it has a volatility and you want to try to take advantage of that. So let's go ahead and move on to the next one. In theory, you can also use the ATR, the average true range, to see how long it will take for the stock to hit your target while day trading. You can take your expected profit divided by the ATR, and that is typically the minimum number of minutes it will take for the price to reach your target. This only works if the stock is on an uptrend and continuing to rise. So here's how that works. So you're on the 1 minute chart and the ATR is 0.05. That means that the price is moving around 5 cents per minute. If your target is for the stock to go up 20 cents, then in theory it will take 4 minutes for the stock to hit your target, because it's going up 5 cents per minute. So 5 cents, another 5 cents will be 10 cents, another one is 15 cents, and then 20 cents. That's 4 minutes. So in theory, it'll take 4 minutes to hit your target if the price continues to go up and moves within that average true range. So if your expected profit is 50 cents and the ATR is 0.05, you can divide your expected profit by the ATR to see the minimum number of minutes. So your expected profit is 50 cents. You're dividing that by the ATR, which is 0.05, and that gets 10, which means it might take 10 minutes for your stock to hit target if the stock continues to trade up and within the average true range. Another way the ATR is used is to determine a stop loss. So a lot of traders will multiply the ATR by 2 to figure out a stop loss. So if the ATR is 0.20, you would multiply 0.20 by 2, which would be 0.40, and then you would set your stop loss 0.40 lower than your entry. So if you got into a stock at $20 and this is the case, you put your stop loss 40 cents under $20. So you can also use this as a trailing stop loss. As the price goes up, you can keep moving your stop loss with it. So you can do this by multiplying the current ATR by 2 and then setting your stop loss below the current stock price by whatever the ATR multiplied by 2 is. So for instance, if the current price is $20 and the ATR is 0.20, well, you will set your stop loss at 0.20 times 2, which is 0.40, meaning you set your stop loss 0.40 below the current price of $20. So your stop loss will be set at $19.60, and as the stock goes up, then you will move your stop loss up. And this is, you use this tactic when you're already up on a stock and you're just trying to secure profit. Yes, that's when you use the current price. You use the entry price when you're setting an actual stop loss, when you're trying to minimize loss. So as the price goes up, so does your manual trailing stop loss. My next video will be going over another indicator that can be used to determine stop losses as well as manual trailing stops, and that's the parabolic SAR indicator, which, like the ATR, was invented by Willis Wilder. So let's go ahead and look at some charts. So we're going to go ahead and go to Webull. So as you can see, I have my ATR. It's a subchart. It's going to be listed right here. You just go to Edit Indicators, look under Subcharts. It's going to be right there under ATR. And press Done. So as you can see on the chart here, so you have some consolidation going on over here. So the stock's kind of trading within a little range over here. Is not going like down hard or up big. So it's kind of consolidating. It's not too volatile. As you can see, the ATR is on the lower end right here. Then when it has that big price drop, another big price drop, another big price drop, a lot of volatility, that's when the ATR starts to go up again. And then as you can see right here, it's starting to consolidate again. So it starts to go down again. And now we're getting a lot of price movement, so the volatility is going back up again. So this can kind of determine how the volatility is going. You can also use other indicators as well to kind of just make sure that you aren't getting any false signals, like the standard deviation indicator. You can use that as well, just to make sure that the ATR is correct as far as the volatility goes. But another way to use the ATR is you look at the actual ATR number. So like I said, you have your first number is 14, which is my default settings. So you're using the past 14 periods, so past 14 candles. In this case, I'm looking at the 1 minute chart. So this is the past 14 minutes that I'm taking into consideration. And then the next number is your actual ATR. So in my case, it's 0.02, or in this case, it's 0.021. So the ATR is 0.02. That's per minute. So in this minute, it looks like it just went up from 1.29 up to 1.30. So it went about a minute, or in that minute, it went about a penny. It went about a penny up. So that's actually a little bit less than average. If you're using the daily chart, which is what a lot of people use this with, maybe this one's not the best one for that because it just had a spike. For instance here, so 0.21 on the daily chart is saying the average true range is 0.21. So in each candle, the average range that it's moving is 0.21. Right now, the stock moved. Looks like it moved 0.03 and after hours 0 cents. So the stock moved 3 cents on the day. The average true range is 0.21. So that means that today, the stock moved way less than average. So it's showing signs of lower volatility, but it's also, actually it's right down here, it's also showing signs that it's showing low volatility, but it's also showing signs that it's moving less than normal. So one can assume that either it just had a big, as you can see, price drop, which would make the average true range a lot bigger than normal. So maybe you want to change the average true range settings to something a little bit smaller that kind of represents just this trading range right here. So like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. So you can do this and you just click 10. So now I'm looking at the past 10 days instead of the past 14 days, which has this in consideration. So now it's 11 cents is the average true range, which is a little bit less. So it is still trading a little bit less than average. As you can see, it was trading a little more volatile over here. Right now it's kind of starting to slow down and it's starting to show that consolidation. Maybe it's a little less risky than it was when it was over here. And then you can use other indicators to kind of determine if it's going to be on an uptrend or if it's the kind of stock that you want to short, or however you want to play that. That's up to you. But this is kind of showing you that right now it's trading less than normal. It's showing signs of less volatility, as you can see. And I'm going to show you all how to use this alongside other indicators that are also invented by or founded by Willis Wilder. So this one, the ATR, is very similar to the standard deviation indicator. And if you missed the video on that, you can subscribe to WTD Penny Boys and view that video, as well as the other trading videos that are on this channel, like the ones going over the Greeks and options trading. Definitely make sure to also go to Penny Boys Stock Alerts YouTube channel, subscribe there as well. We have every Wednesday we do live trading, and we're going to be also putting some advanced trading videos and a bunch of great videos on there as well. So make sure to check that out. You can also go to pbalerts.com/stock trading university and go to the free alerts section. There you can find free alerts as well as some free trading classes going over charting indicators, how to trade while working 9 to 5, and a few other bonus topics. You get a handout as well as a video going over that class topic. And this is the same exact format as the PBU 3-month trading class program. So if you do join PBU, you get a video, a handout, and homework. And if you get 100% on the homework, you get raffle tickets for the weekly $75 cash giveaway. So PBU is a 3-month trading class program. We go over everything from trading strategies, psychology, charting, candles, and of course creating a PBU trading plan. There are also advanced trading classes as well. And PBU 2021 quarter 1 just started, so it's not too late to join. So check out the free Discord at pbalerts.com/stock trading university. That's pbalerts.com/stock trading university. And if you want to join our premium alert service, check out pbalerts.com and use the code WTD5 for $5 off. You get $5 off premium alerts, the 3-month trading class program that comes with the premium membership. You get access to the cash giveaways and an amazing trading community, and so much more is included with the premium membership. So next video we will be going over another indicator that was invented by Wallace Wilder, the parabolic SAR. So I hope to see you then. We have our PBU live stream coming up on Thursday, 9 p.m. Eastern Time Zone. So make sure to subscribe to this channel to get the link to that stream. We will be doing our $75 cash giveaway and going over some more charting indicators and trading tips during that stream as well. So join pbalerts.com/stock trading university for the free Discord to see how to enter the raffle. And be sure to like and subscribe and join me, What the Duck, on Thursday for the PBU live stream. But until then, I hope that you all make some bread.